What are you expecting from this huge week of earnings? How do you see it impacting the market?
Well, so one of the things that we had seen in the last 2 months was that after we had the mini banking crisis, you did see a number of analysts really downgrade their expectations for quarter one. And as a result, it seems like a fairly low bar for a lot of the earnings numbers that we're going to be hearing from both you saw from last week and also, of course, this week too. So actually, we're not expecting to see major disappointment. We are expecting to see a continuation of this very modest, gentle slowdown that we've been experiencing over the last couple of quarters, but certainly nothing which is necessarily going to be the catalyst which takes down investor sentiment at this stage. We are going to be looking out very closely for anything on guidance. You know, what are they talking about margins? Are they feeling any kind of pressures? Do you start to hear anything about struggles given the increasingly challenging economic environment? So those are the things that we're going to be hearing from, but it's really about the guidance rather than Q1 that we're going to be looking out for.
Okay, you just mentioned margins. Last week, we had a guest come on and say he's looking at the margins when it comes to consumer staples, consumer packaged goods. Last week, consumer staples, that was actually the best performing sector, and a lot of the stocks in that area, they were some of the best performers. I'm talking about a Clorox, a Molson Coors, a Kimberly-Clark. What does it say that that was the best performing sector last week with so many of those earnings coming up this week?
Well, it is interesting because consumer staples is typically your most defensive, one of the most defensive sectors. So actually, as times get a little bit more challenging, consumer staples is a sector which should be outperforming. It's the more cyclical ones, like consumer discretionary, that we would expect to be showing increasing signs of struggle. But I have to say, look, if you just look around at the economy today, everything looks fairly robust. There's a lot of strength out there. So we're not expecting to see very, very significant signs of strains, but it's starting to see kind of little hints of weakness starting to come through. That's what we're expecting.
What about allocation? Where do bonds come into play right now? Where do equities come into play? Last week, we also saw some stats where money was coming out of money market funds. There was some thought that was to pay off tax bills, but just that trend in general, do you see that continuing? Investors taking their money out of safe instruments and putting them back into riskier assets, which at this point are equities?
So we're not expecting that to be a continuation of that trend. So as I said, today things look okay. But as we start to think about the coming quarters, we are expecting things to become more and more difficult. You know, we just have to think about the amount of Fed tightening that we've seen today. Inevitably, you will start to see the negative impact of that onto the economy and therefore onto various stocks, etc. So from an investment perspective, this pulling out of money market funds probably isn't going to continue. Within fixed income, we do like it, but we're really focused on the more stable elements, more quality stuff, which should outperform even as things get tougher, whereas equities, we think, will be under pressure increasingly as you go through the months ahead.